Very much looking forward to this talk, Dean. And I have personal investment questions, and I know you're going to be expecting those, so I'll save them till later. But you know, my portfolio, quote unquote portfolio, you know, well, first I should ask, how much is yours down, you guys? Is your portfolio down at all?
We're currently performing above the benchmark. About
Okay.
1% above the benchmark.
So they were down, what?
They were down about 3% when the benchmark was down 7 to 8%.
That's me. You're talking about me. I'm down 7 or 8%.
Well, then you did average, Janet. So here's your first thought exercise of the evening, Janet. If we are all the people in this Zoom session are all the people that exist in the world, collectively, we own the stock market, and our average return has to match the average return of the stock market. So for one of us to beat and earn better than the stock market average, that means...
So you're saying that I'm the reason you did better. Well, and I did a little experiment where I have some of these in the like very sort of, they seem like high fees, but they ended up having less. Wait a minute. So they had higher fees, like one of the freedom funds, or several of the freedom funds. So they had what I thought was a little bit higher fees, but on the other hand, there's somebody's actively managing them. Well, and even though it had the higher fees, it outperformed what I chose. So that's the end of my experiment. I'm just going to go with basic stuff,
We're going to cover all of those topics, I think, or at least touch on them.
Yeah, no, it would be good. I need to start paying a lot more attention to this now that I'm, before retirement was off in the future, and now it's like probably within the next 10 years. And I'm like, maybe I should start paying attention to this stuff. All right, I'm going to make sure I can share slides and kind of get ready for that. So did you do any fishing? Do you do ice fishing, Dean?
I do go ice fishing, but
Do you put a shack up in the whole thing?
No, I don't. In the years past I have, but again, as you know, being the dean, deans don't have too much time for that type of stuff because we're hosting Husky Bites and doing things like this. So no, I do but I figure I'll save it for the summer and work in the winter up here and save for our glorious summers for our time off to fish.
Let me take that down. There we go. I have never ice fished. I mean, it seems, I don't know. I guess you could do it reading a book, right? You could be sitting there
Yep, you can
in the little shack.
Yes, you can be very aggressive into it, or you can be very passive. You can be very active.
Do people like dunk it up and down when they're ice fishing, or they?
Yes, so you can be very active and jig, or you can just set your lines and be very passive. And Jada's smiling because I'm using the terminology from in finance investing. You can invest very actively, or you can invest very passively.
You can jig or you can jag.
Exactly.
All right, I am going to share screen and get my slides ready. And I have been signed out. Weird. Am I still here?
Yep.
What can you see? Can you see anything?
I can see your Husky Bite slides starting up.
All right, good. Right, what I wanted to do. All right, this should be full screen now. All right, let's give it 20 more seconds so that I can be on time. I am very excited for this talk. No, I am. I've been looking forward to it. So, and I believe this was one of the talks that was Sue's idea, if I remember correctly, because she was like, why don't you have the APMP, the Applied Portfolio Management Program on? All right, let's go ahead and get started. Welcome everybody to Husky Bites. My name is Janet Callahan. I am the Dean of the College of Engineering, and I serve as host of Husky Bites, which features people from all over Michigan Tech, including alumni, current students, faculty, and so forth. So welcome to Husky Bites. We are in season 7. Please, if you ever would like to email me, my email is provided. It's callahan@mtu.edu. And if you would like to give, we now have a tinyurl.com/COE-give to make it kind of easier to give. We are more than halfway through the season at this point, and we'll be hearing from the Dean of the College of Business, whose name is also Dean, so he's the double Dean, Dean Johnson, and we'll be hearing from students as well. I want to point out that next week we will be off for spring break, and then there are 4 more coming up. The next one coming up again is 2 weeks from now, and that will be on March 13th. It is one of our enterprises. It's one of the enterprises called Consumer Product Manufacturing, and really looking forward to that. I wanted to show you some of the things that I am doing on weekends with my dogs, because as I may have mentioned to you, my husband is bicycling from Florida to California. So we went skiing. We had beautiful blue skies. I want you to see the joy that Echo the Husky has out there skiing. You can see that I'm cross-country skiing, and she just has a ball out there. So that is Echo saying hello to you from one of our beautiful cross-country trails that does accept dogs. And this is a very tired Echo. And I was thinking, so her ears never go down. Can you imagine having radar like that up all the time and know, like, she can hear while she's asleep? I don't even know if she can sleep with ears like that. So we are live streaming this at a slightly different location. And so I apologize for that if you're trying to join us. With that, I just want to thank you and to remind people that for questions, just type them in the Q&A feature and we will get to them afterwards. And so I am now going to stop sharing Dean, give me a second to transition to you.
Are you seeing my screen, Janet?
Yes, I can see your screen. All right, so at this, now I would like to introduce my co-host this evening, who, like I said, is Dean Johnson. He is Dean of the College of Business. He is the James and Dolores Trethewey APMP professor. He is the founding director of this program that we're going to be hearing about, which is called the Applied Portfolio Management Program. Dean has been here at Tech since 1996, and he has been Dean since 2016. So he is, I think you're our longest standing Dean in our group of deans, Dean. Let's see. When I was looking you up, I had not realized you were such a distinguished professor. You are Professor of the Year by the President's Council of all of the universities in Michigan. You've twice received the Michigan Tech Distinguished Teaching Award. You have received the SBE Outstanding Teaching Award. You are the U.S. Professor of the Year award, and I don't think there's a teaching award that we have or that I've even heard of that you haven't been awarded. So with that, Dean, I turn it over to you to introduce the rest of your team, and I'm looking forward to the show.
Thank you very much, Janet, and I'm looking forward to tonight as well. I did invite 3 students to present, and I am going to save time for our conversation and go ahead and ask them to introduce themselves and begin our presentation.
Hi, everyone. I'm Jada Hamar. I am a local student from Houghton and actually a new alum. I graduated this past December with a bachelor's in finance and a minor in economics. And I just started my first post-graduation job at Ameriprise here in Houghton. And to begin, I guess I would like to ask everyone to grab a piece of paper and a pen or a pencil to keep handy. And we're going to start with some questions. So I have 2 questions for the audience, and for each question, I'd like you to write down a lower bound and an upper bound such that you are 50% confident that the actual answer lies between these 2 bounds. So my first question had to keep it UP Houghton related. is how many tons of concrete and steel are in the Portage Lift Bridge? So I'll give you a second to kind of think about those bounds and write them down.
And remember,
And
a ton is 2,000 pounds.
yes, that is helpful to keep in mind as you're writing these down. So
That's one
once we-
heavy bridge.
Yes, I'm sure many of us have driven over it many times. Not something you typically think about when you do that. And the second question, once you wrap up that first question, is how much water is in Lake Superior in gallons? So biggest freshwater lake.
Wow.
Yeah. So upper and a lower bound for that, and just that you are 50% confident that the actual answer lies somewhere in there. So while you guys write those, I'll turn it over to Jaharee.
Hello, thank you guys for having me. My name is Jaharee Weah. I'm a finance major. I'm from Madison, Wisconsin, and I spent 4 years on the Michigan Tech football team. I currently don't have a role lined up, but I'm interested in finance and also sports. And my question, I'd like you guys to write it down on a piece of paper, is to write a whole number between 1 and 100, where your number is 2/3 the average of everybody else's number. I hope that makes sense.
So your number is 2/3 of the average of everybody else's number. That's the number that you're writing down on your piece of paper. And so we'll come back to these questions later in the presentation, obviously.
Wow.
Hi everyone, I'm Kasey Kangas. I'm from Calumet. Like Jada, I just graduated in December. I have a bachelor's in accounting and finance, and I'm currently working as an accountant at Aspire's CUNA Hospital. And my question for everyone is, if I can accurately predict which way the stock market will move for the next N years, you'll invest your money with me. And what is your N? How many years will you invest your money with me?
So if Kasey can tell you correctly which way the stock market's going to go up or down for the next N years, if she could do that, you would invest your money with her. What would be the N that would make you do that? So just write your number down. All right. So we're going to come back to these questions later, and we're going to have the students spend some more time with us. But let me go ahead then and get us going here. So volumes and volumes and volumes have been written about investing. It's a huge topic. I could talk about a ton of stuff tonight. Many times when people speak about investing, they do some very narrow topic because there is so much to talk about. But I've gone ahead and decided that we're going to bite off a big chunk of the apple tonight, and we're going to try to take a macro view of investing in the public markets. In other words, stocks and bonds, trading through in the publicly available stocks and bonds. All right. We're not going to talk about trading strategies per se. We're not going to talk about private equity. We're not going to talk about get rich schemes. We're not going to do what is this and that type of thing. We're going to start by this big macro view. And what I want to really do is I want to make you think philosophically about investing. I want you to raise your awareness of some of the key thoughts and contributions in the field of academics that have shaped finance. And of course, we're going to be picking those. We're going to do it at a high level. And in the end, what I hope that we're going to be able to do is get you to the point where you can develop your own systematic approach to investing, or at least think about it from a systematic, and hopefully act for your future and act wisely and knowingly. Just again, like we could ask lots of questions, but I'm just want you to realize that investing is a tool. And just like any tool that we use every single day around the house in our lives, tools are very useful, but tools can also be dangerous. So the more we know about the tool, the more comfortable and confident we can become, the more we're likely to do well and use it. So that's kind of what we're trying to get at here tonight. So what I'd like to do is start off the evening by asking you yet again another question. And hopefully this can be brought up as a poll. I think Sue's going to be able to bring this up as a poll question. So the question is how many years of investing experience do you have?
define experience.
Ah, that's a good question too, Janet. In and of itself, that's a great question. And it looks like we've getting pretty much solidified here that it looks like we have a pretty sophisticated group of people here tonight, with about 80% of our people in attendance having 15 plus years of investing. We do have a few people that put 0, and I suspect the actual answer is 100%. Okay, so I think Sue just shared the results. We ended up at 80% that had 15 plus years of investing experience, 13% between 5 and 15, 2% between 1 and 5, and 5% was 0. And I want you to realize that investing actually is simply the sacrifice of dollars today in the hopes of increased dollars in the future. If it's risk-free, for sure, how much money you're going to get in the future, that's risk-free investing. But most investing is risky investing. I bet you all of you have done investing because you got an education. Even if you got an education as an elementary school, high school, you were sacrificing dollars. You could have been out working, skipping high school. You sacrificed dollars to invest in your education. Those of you that paid are Michigan Tech alums, of course, you paid some tuition. And why did you do that? For increased dollars in the future. And again, Michigan Tech, we're very, very proud of our return on our investment. So I would argue that every single one of you has been an investor already in your careers. So what we're going to talk about next is before we dive in, is I want you to realize that sometimes investments gets a bad name. And people focus on somebody that did something horrible and swindled people out of money, or they deceived people, or sometimes we hear about a company that made a lot of profits. And I want you to stop and again, just think about what investments really does. Think about the Michigan Tech Smart Zone. We have all these fledgling companies that we're trying to launch. And one of the main things they need is capital. They need money. They need investors. So investments really at its root, at a macro level, is a huge benefit for society, and it increases the standard of living of all people, because the goods and services that increase the standard of living can be produced by these firms if they have access to capital. At the micro level, I think this is probably what we're all thinking about, is it breaks that linkage between your income and your consumption, i.e. we can work and then we can retire. And that's what we're interested in doing. So it benefits us that as well. The last thing I want to point out to you is that equity, stocks, are what are called a residual claimant. They're last in line. They get the residual. So in other words, workers have to get paid first. So by having a company, our workers get employment. The taxes have to be paid to the government next. The bondholders and the bank have to be paid next. And it's only after all of those people are paid that if there's any residual left, that residual can go to the equity holders, the stockholders. Now realize that residual could be quite large. It could be small, and in many cases, it's negative. So the point is that the equity holders are last in line to get paid, but yet they have the voting rights. They get to elect the board. So the board is trying to look out for the equity holders who are last in line. And by doing so, that ensures that everybody else that are claimants before them get paid as well. So this is pretty important because, again, what we can see is that once a firm has some profitable thing that they're doing, okay, they're going to continue to do that and expand and grow the company, because anything that they do, that residual flows to the stockholders. Just as a thought exercise, imagine a firm where the bondholders, and if you know what a bond is, a bond gets paid a fixed payment. A bondholder gets only a fixed payment from the firm. If the bondholders were running the company, as soon as the company made enough money to pay the bondholders their payment, the bondholders would tell the company to stop. Don't do anything else because you've made enough money to pay me. I don't want to lose it, so don't take any more risky projects. Just stop. All productivity. Our companies would be way less productive. Our society would be way less productive. We'd have way less in tax revenue, all those different things. So I think when we really stop and think about it, is that investments is a good force in our society. Again, we can talk questions at the end if you have any questions about that. The next thing is I want you to realize that there's lots of different assets out there. We can go ahead and do financial engineering. So Janet, this is actually a name of a course in the College of Business, and we named it financial engineering because we knew it'd get everybody all excited at Michigan Tech. And really all financial engineering is just bundling and unbundling cash flows to create new assets. And then investors can pick whatever their desired risk profile is. A really simple example that probably almost all of you are aware of is mutual funds and exchange traded funds. Basically, a mutual fund is just simply a middleman. They go out and buy all the stocks and all the bonds of the companies. So I'm over here in my little diagram. And we, as individual investors, can go ahead and buy shares in the mutual fund. And what they've done is they've rebundled, repackaged the risk of the individual assets. They've diversified the risk of the individual assets. There's lots of financial products that are always being created. If I don't want to lose my audience tonight, but like right now, there's a new product that's just coming out called single stock ETFs. And the question is whether or not that's a good product. There's another new product, a relatively new product out there called MPI. It's basically universal index life insurance. And everybody's talking about it, whether it's good or bad. New products can be introduced. Those new products can be dangerous. They can concentrate risk. They can be inappropriate for certain investors. They can be so complex that it's very difficult to understand what they are. And then they can be unethically marketed to investors. Again, if you go out right now and look around at a gentleman by the name of Curtis Ray, he is marketing his insurance product, and most people would argue it's a very unethical marketing going on. So the point would be is investments can be a force for good. However, they come with dangers. Buyer beware. You need to know what you're doing. So Janet and I were having some conversations before the meeting, and very much the same situation. You need to have some idea of what's going on here. Oops, just a second. There we go. I interjected a few photos through the presentation just to give you some ideas about APMP and the success of APMP. This is Tony Hellenbrand being interviewed in New York by Larry Kudlow and Aaron Burnett. And so just to give you an idea of some of the exposure that our program has had. So real quick, trying to go through this quickly. Investments goes all the way back to Mesopotamia, back to the Roman Empire. First stock exchanges already started in 1602 in Amsterdam. But in this pre-1920s, basically, people were just buying and selling and trading. There was no science, if you will. There was no structure. And basically, you could argue that it was purely speculation, that basically it was glorified gambling. There was no connection between the stock price of the asset and the performance of the company. And finally, in 1930s, that finally changed. In 1930s, a couple of famous books were published, and it introduced the idea of fundamental analysis. And fundamental analysis is simply looking at the financial performance of the companies, the balance sheet, the income statement, looking at how much cash flow the asset can generate, looking at the risk of the cash flows, and thinking of those assets as having a value that's based on the present value of their cash flows. So for stocks, that would be the present value of their dividends. And so finally in 1930, and by the way, if you're old enough to remember this, there was the great crash in the stock market back in the 1920s. We had the Great Recession. So it was following that we finally kind of got our acts together and realized that we should think of things rationally a little bit and look at how the company's performing. And we finally brought some discipline to how to value individual assets. But we didn't have any idea how to form portfolios and how to pick and look at assets from the viewpoint of forming a portfolio. So, next question for the audience. I want you to consider flipping a coin. And so Sue hopefully can bring this poll up. I think we have this as a poll question. I want you to consider flipping a coin until a head is flipped. And the asset will pay 2 to the nth power. Okay, 2 to the nth power, where n is the number of times until I flip a head. Okay, so everybody understands. So if I flip the head the very first time, n is equal to 1, and the asset would pay $2. If I flip the head on the second flip, it would pay 2 to the second power, and it would pay $4. Now we don't have enough so you can answer any specific, so we just picked 4 possible answers that you would pay $2, $20, $100, or an infinite amount. And so go ahead and pick the answer that's closest to the number, and realize you have to pick a number that you'd be willing to be on either side. You'd be willing to pay this amount of money to get the outcome of the coin flip, or you'd be able to receive the money and then be the one flipping the coin. All right, so we're bouncing around. I'm starting to see some patterns here. We'll let Sue decide when to release the poll results. We got about 60% of the audience has responded. All right. So I think Sue shared the results. So for those of you that answered $2, you guys are cheap dates. Because the worst possible case is I flip ahead on the very first time and it pays $2. So if you're willing, I would be willing to pay you $2 and let you flip the coin for me, because worst case, I'm going to break even, right? Remember, I said it's got to be the fair price, whether you are the flipper or not. Okay. Now, for those of you that sit in infinite, okay, that's pretty interesting. What I want you to realize is that this is basically an asset that has some random cash flow. And actually, we know the risk of the profile of this asset. We know exactly it's a 50-50 coin. In the real world, we don't even get that. We don't get the probabilities and the cash flows. Basically, I asked you guys to value a stock. And as an audience here, we came up with the answer that we think the stock is worth somewhere between 2 and infinite. Okay, that's a pretty wide range. Now, I suspect those of you that picked infinite did so because you did this calculation. So this thought experiment right here is called the St. Petersburg paradox. And it's basically the expected payoff of that coin flip is infinite. So again, there's a 50% chance you flip the coin the first time and it pays 2 to the first power. $2. There's a 1/4 chance you flip ahead the second time, in which case it pays 2 to the second power, 4. 1/8, 8, on and on and on. The expected payoff is infinity. Okay. Now, let's do another thought experiment. You have $10 million in your bank account. Would you be willing to enter into a zero? Double your bet, double or nothing, 0 or 20 million. We didn't pull it up as a poll question, but what I want you to realize is that almost everybody, if not everybody, would answer no. They would answer no. And the reason is that if you would take the bet, okay, you're going to end up with either 20 million or 0. Right now, you could go ahead and consume $10 million. Janet, I bet you could live pretty comfortably on $10 million, right? Okay. Yep. So Janet, how bad would it hurt your feelings? How bad would it hurt your utility, your satisfaction in life if you had $10 million and then instantly you had 0 and you were penniless for the rest of your life?
I would not do that risk. No way.
Right. And yet, if you had 10 million and you gambled and you got 20 million, the extra 10 million would make your life better, but it really isn't worth the risk of being penniless. Would you agree, Janet?
I agree with that.
Okay. So I think what you all are telling me is that you're risk averse, that you view $10 million for sure as better than a 50% chance you get 0 and a 50% chance that you get 20 million. The expected payoff of the gamble was 10 million. A risky 10 million is not as worth the same amount as 10 million risk-free. You all are risk averse. So let's do it one last way. Let's now apply this to assets. So basically, what it comes down to is you are risk averse. If you had a chance to earn $10 risk-free, or you had an asset that paid $110, either 0 or 220 with equal probabilities, the expected payoff is 110. Nobody would buy asset 2. The only way to get asset 2 to be bought is to offer a risk premium. And let's go ahead and assume that the asset would sell, instead of selling for $100, asset 2 sold for $90. Asset 2 would earn a 22% expected return if it sold for. The question in finance, the biggest question in this finance, is how in the world do we figure out that rate of return, that risk premium above the 10% return? How do we know what is the required rate of returns on assets? Well, how do we know what the required rate of return on portfolios is? So I see I'm going way too slow, so I'm going to speed this up a little bit. Okay. Here's some pictures of the students opening the NASDAQ Stock Exchange, and I'm in that photo as well. So basically, if those of you that know statistics, this is basically straightforward statistics. If we want to look at portfolios, putting together a portfolio is nothing more than putting together random variables. The random variable being the return on the risky assets. So a gentleman by the name of Markowitz founded modern portfolio theory, and it's a pretty simple result. The return on a portfolio is a linear combination of the returns. So the expected return on portfolio, P, is the weight, the percentage of money you put in asset 1, times the expected return on asset 1, the weight, the percentage return, the percentage weight that you put in asset 2 times the expected return. But the risk, the variance of the portfolio, sigma P squared, is not linear. It's a nonlinear. The subscripts are the assets. The superscripts are actually powers. The weight in asset 1 squared times the variance of asset 1, weight in asset 2 squared, the variance of asset 2, 2 times the weights times the correlation between the two assets times the standard deviations. If you draw it on the graph, this is what it looks like. Here's an example of two assets, Ford and IBM. So up here is 100% in Ford and 0 in IBM. Down here is 100% in IBM, 0 in Ford. If you put a portfolio together and put half your money in Ford and half your money in IBM, half your money in Ford, half your money, your return is going to be halfway in between, but your risk is not going to be in between. Your risk is going to be way down here. This is diversification. And so now I want you to stop and realize the question that we have is how to solve for the optimal portfolio weights. This is what finance is about now. This is what portfolio management is all about, how to pick the optimal weights. So I want you to stop and realize that this point right here is a really cool point because it has the lowest standard deviation, the lowest risk. From this point, if you move in this direction, you earn higher returns. But if you move in this direction, you increase your risk and earn lower returns. So nobody's going to want to be on this blue section. Everybody's going to want to be on this yellow section. Higher returns, higher risk. Okay, and it all goes back to the equation. To give you a little bit of an example, here's some historical data using two assets, stocks and bonds. Okay. Thing to notice is that this slope gets flatter and flatter. The more risk you take, the flatter the slope gets out here. Okay. Every additional unit of risk doesn't get you the same extra return. So now I know this is Michigan Tech. So we're going to skip through this. For those of you that don't like, if those of you that like linear algebra, you can do this. Those of you that don't like linear algebra, don't worry about it. It's still the same point. The returns are linear. The risk is not linear. So these are the linear algebra notations. I'm not going to go through this because of time. But the point would be, if we got Michigan Tech audience, if you're a linear algebra person, this is you rate URA team. Okay, same equations. Okay, and so the point now is we can solve using optimization tools. And those of you remember, how many people remember their calculus? Finding the max of a function, take the derivative, set it equal to 0. You can use the calculus approach, or you can go ahead, for those of you that are younger and have used to computer programs now, numerical search methods, MATLAB, Excel, Mathematica. We can go ahead now and solve any problem we want to solve using our optimization. So for instance, let's say that, Janet, you told me you were risk averse. Janet, I think you told me you like higher returns, right?
Mm-hmm.
But Janet, you told me you didn't like risk, standard deviation. You chose the risk-free asset with 0 standard deviation versus the risky asset that had the same return, but had a positive variance or standard deviation. So you don't like risk. A is your coefficient of risk aversion. Well, Janet, I can go ahead now. Your return on your portfolio is just a weighted average of the returns of the assets. And the risk of your portfolio, the variance, is just this. And I use the linear algebra equations, but don't worry. You can just think of it as this equation. I take the derivative with respect to W, set it equal to 0 and solve, and there's my solution. Boom, done. Or I can use numerical search methods. All right, I'm going to keep going. What happens now if there's 4 assets? So here's our 4 assets, A, B, C up here, and D. The answer is exactly the same thing. We can go ahead and form portfolios, but we're still going to get this same shape, this same bullet shape. And the answer is, we don't want to hold asset A by itself. We don't want to hold asset D by itself. We don't hold B. We could create this portfolio P, which is some combination of A, B, and C, and D. But we don't want to hold that either, because from P, we could do better by going up, higher returns, move in this direction, or less risk, move in this direction. We only want to be on this frontier right here. We only want to hold the portfolios that have weights that put us on this line. And again, that's nothing more than a mathematical optimization problem. And we can solve it using linear algebra, or we can solve it, calculus, or we can solve it using numerical search methods. Okay, so hopefully I've not lost everybody so far. But what I wanted to let you know is that this is a ripe area that Michigan Tech students that have technological skills, our math, stats, quant optimization students can do. Here's the golden rule. You don't deserve to earn a higher return for holding diversifiable risk. As we add, every time we add an asset to our portfolio, the risk of the portfolio can go down. So on my graph here, as I hold more assets, the risk of the assets go down. Now, Janet, I want to make sure we end in time for Q&A. So I'm behind. I got to go a little faster here. So I'm going to skip some slides. So the point is, you only earn a risk premium for bearing risk that can't be diversified away. Somebody has to bear this risk. It exists in the economy. Somebody has to bear it. You all told me that you're not going to hold asset 2. Somebody's got to hold asset 2. The only way we can get people to hold asset 2 is by offering a 22% return on asset 2, a risk premium. So what we basically have is we have the holy grail. how can we measure non-diversifiable risk, and how can we figure out how much of a risk premium we should earn for bearing it? Okay, I'm going fast, I apologize. Here's some students again on Times Square, winning the competition, being inside up on the Times Square bulletin board, pretty thrilling for the students. So I'm going to skip that slide, and we're just going to go to this equation right here. This is the CAPM equation. It basically says that you should earn the risk-free rate, and then you should earn a risk premium. And we finally came up with a model, and the model basically says the risk premium should be the beta of the asset, which measures the quantity of risk, and then the return on the market portfolio. The market portfolio is all the assets in the world. All the assets in the world held in their market cap weights. So they came up with the CAPM equation in 1960s. And I'm way behind, Janet. This is going way slower than I thought, so I'm apologizing, skipping ahead. So there's our equation that we should be able to put in and find out the risk-free rate was 10%, and that risk premium there was 12.2%. All right. Why is this important? Because now we know how to figure out what our fair return should be on assets, and we can also use this equation to figure out our fair return on the portfolio. So here's the students on national television from Houghton, from the president's office, going to a conference as well. So 1970s, the idea became, wait a second, what if instead of there being one source of risk, one risk premium, what if there was K sources of risk? And the idea would be, well, if there was K sources of systematic risk, then in the same idea, you should earn a risk premium for each source of risk. So in this equation, lambda is your risk premium, and beta, again, measures your quantity of risk. Steve Ross came up with this model. Steve Ross's PhD student was Ziwu Chen. Ziwu Chen was my PhD advisor. So you can tell where I'm at in this conversation. Steve Ross should win the Nobel Prize. He probably will. So if you review now, we have the CAPM model, which says there's one source of risk, and it's called market risk, and you deserve to earn a risk premium for it. And now we have the APT model, which says there could be K sources of systematic risk, but the same thing, you should earn a risk premium. So the poll question for the audience, and I know you have limited information, maybe you've already heard of some of these things. The poll question for the audience is, which one do you think is correct?
I'm surprised you didn't add choice C, both, because I would have chosen that one.
Janet Callahan might actually have a good answer, the right answer potentially. So 65% of people said APT, 35% said CAPM. And the answer is, Janet, the CAPM is a special case of the APT. The CAPM is a special case of the APT where there's only one factor, and the one factor is the market portfolio. So the CAPM is a special case of the APT where there's one factor, and the one factor is the market portfolio. There could have just been one factor, and this lambda here was RM minus RF.
Yep.
So the CAPM is basically a special case of the APT model. So basically, what's happened since 1970 to today is everybody's running around trying to figure out how many factors they are. What are the different factors? That's what's basically been happening for the last umpteen years. So I'm going to try to jump ahead because I'm running out of time. You can go ahead and I'll share these slides out. You can go ahead. Here are some of the most popular factor models right now. The Fama-French 3-factor model that says size is a factor. Small firms are more risky than big firms. And then value versus growth. Value firms are more risky than growth firms. Okay, you can go out to this dimensional website. It's a fund company that actually manages money using Fama French factors and other factors as well. So that's basically what's been going on in modern finance for the last umpteen years, is trying to figure out what the factors are. What's happened to today is that we are basically trying to go ahead and improve the estimates, because if you remember, to do the optimization, we have to do the optimization. I have to do the optimization, I have to come up with the expected return on the assets, the expected return on asset one, the expected return on asset two. I have to estimate the variance on asset one, the variance on asset two, and I have to estimate the covariance. Those are my inputs. Once I have my inputs, I can solve for my optimal weights. If I have bad inputs, bad errors in my estimates, I'm going to get bad weights. So a lot of the research that's going on nowadays is, how can we make sure we have good inputs and then use our optimization, avoid garbage in, garbage out. A really cool model is the Black-Litterman model, which solves backwards. And it says, wait a second, if IBM has a 1% market cap weight, what must the market expect the return on IBM to be so that 1% is the optimal weight? And then you can ask yourself whether you agree or disagree. If you want to play around with factor models and Black-Litterman, you can go to this website, Portfolio Visualizer, and do that. Finally, the next thing going on is using artificial intelligence, machine learning, things like that to manage money. All right, I'm going to go ahead and jump to our students, okay? The question becomes whether or not markets are efficient and assets only earn their fair return, or whether or not you can beat the market. Can you use available information to beat the market? And to beat the market, what I mean by that is you have to earn more than the asset's fair return, more than the 22.22%. Okay, that's really becomes the question. If you can't, then you should be passive. And if you can, you should be an active portfolio manager. I'm going way too slow. I put way too many slides in, Janet.
Just like a professor.
Just like a
a
professor.
typical professor.
So,
that's okay. We often run over.
okay. So here's basically what's gone on is along comes Kahneman and Tversky, along comes psychologists, and they basically poke holes and they find all kinds of anomalies and failings in human beings. We find that human beings make poor decisions, we make bad decisions, we make mistakes. And the question is whether or not those mistakes are predictable and repeatable. We started seeing anomalies in the markets, winner losers. Firms that were the biggest losers in the last 3 years became the biggest winners in the next 3 years. Warner DeBont, very good friend of mine. Small firm effect. Firms that are small earn higher returns than firms that are big. So are those anomalies that are mistakes that are being made in the market? And so let's go back now to Jada's question. Jada?
Yep. So to go back to my question, the correct answer for question 1 is how many tons of concrete and steel are in the Porter's Lift Bridge? The answer was 42,000 tons. And for how many gallons of water are in Lake Superior, the answer is 3 quadrillion gallons. So to go through, kind of answer, how many questions did you get correct with your lower and upper bounds?
0 for Janet. My upper guess for the weight of the bridge was 20,000 tons.
Yeah,
and
so kind of going.
I capped my Lake Superior capacity at 100 trillion. I didn't think of going in the quadrillions.
All right, so right now there we go.
All right, so it looks like this will help me with my next slide. We had around 78% with 0, correct. So to go through to the next, we talk about behavioral finance and we talk about overconfidence. So how many of you selected lower and upper bounds so wide that they provide practically no value in estimating the correct answer? This might have been if you had gotten both of the answers correct. And if you had gotten 0, where your bounds were too small and you were too confident, overconfidence in our abilities can be very detrimental when it reflects in our portfolios. So overconfidence bias tricks the brain into believing it's possible to consistently beat the market by making risky bets. But the evidence shows that even financial experts with all the powerful tools and at their disposal can have difficulty outpacing the market. So this leads to excessive trading, high transaction costs, undiversified portfolios. And sorry, guys, you tend to be overconfident because we're level-headed. So is overconfidence a persistent feature of humans, and will it occur in the future? And can we ex ante identify and execute trading strategies to capture the effects of overconfidence? And lastly, can AI identify overconfidence? So overconfidence can happen in your portfolio, but it's something that happens in the market that you can also use to your advantage. So to prevent overconfidence in ourselves while we're investing, you can manage money as a team, as we do in APMP, and it's super helpful to be working with other people and taking all of that insight to kind of fight the overconfidence that you tend to have in yourself. And then seeking a second opinion as well. And lastly, working with a financial advisor.
All right. So 78% of our people were overconfident. 18% got one right. Good job. And again, 4% picked ranges so wide that we're probably maybe there was not any value. Maybe you were just guessing 0 and infinity. You would have gotten it right, but that's not what we want if you're trying to value stocks. All right.
So my poll question, going back to it, what was the number that you selected? A, B, C, or D?
So Jaharee's question is pick a number that's 2/3 of the average of everybody else's number. So go ahead and fill in what range.
My number was 30, so I'm in the category D,
Okay.
like everybody else.
This is really going to be interesting.
Fascinating. So the ranges are A is 1, B is 2 to 8, C is 9 to 20, and D is bigger than 20 and bigger.
All right, let's go ahead and end the poll.
So yeah, seeing our results, it looks like about almost 70% of people guessed more than 20, and only 20% guessed 9 to 20, 8% guessed 2 to 8, and only 3% of people guessed 1. So the 3% of people that guessed 1 were actually correct, and they were rational. And the reason because of that is that when you think about 2/3 of the average of everybody else's number, you're trying to get lower and lower and lower, and eventually you'll get to the answer 1. And that was like the rational answer, but obviously it's not the correct answer. So we use like this thinking in finance as well. And in finance, there's rational investors and irrational investors. And they play into the idea of noise trader risk. So noise trader risk is the possibility that a well-disciplined and knowledgeable traders can lose money due to excess of noise in the market. So like we were saying earlier, the people that all said that the answer wasn't 1, they were irrational thinkers. And the people that said that the answer was 1 are rational. So this like plays in a real example of this has to do with GameStop. And GameStop, the idea behind that was there was a group of people on Reddit and online that were irrational investors, and they were trying to inflate the price of the stock and going against the other rational investors in the market. So for investing in APMP, we have to think about, do irrational investors create a noise trader risk, or do rational investors drive out the irrational investors out of the market and keep prices correct? So for GameStop, I would say that the irrational investors created a lot of noise trading risk for a while, and you saw how GameStop lasted, and it didn't crash for a while, but eventually the rational investors were able to push out the people from Reddit, and they were able to like correct what the price was.
So again, you should have guessed a number less than everybody else's, but then you realize they're guessing a number less than you, which then makes you have to guess. So the rational answer was 1. Even though you were right, and you said the rational value of the stock was $1, the actual stock price turned out to be higher. You were rational, but you ended up being wrong. So that's essentially the concept of noise trade or risk. So what we're talking about again is all those models that I talked about, the APT, the CAPM, were based on the assumption that people are rational. Okay, and maybe people aren't.
Right, so going back to my question of how many years would it take for me to correctly predict which way the stock market will move for you to invest your money with me? The choices are 1 year, 2 to 4 years, 5 to 7 years, or 8+.
I'm really bad at this. I have no intuition on these answers. I'm afraid to say what I guessed here, but I did choose B here. So 2, I chose 2. I would trust you for 2 years.
Yeah, it looks like a bigger spread than the rest of them. We have about 50% at 8+, 30% 5 to 7, 10% 2 to 4, and 15% said 1 year. So if you want to go to the next slide, Dean. It's
Just a second. Just a second here, Casey. There we go.
Okay, so in the financial markets, it's really hard to distinguish between luck and skill. So for me to correctly predict which way the stock market would go, I could just open up a bunch of newsletters and one of them will eventually be right. So like if somebody wanted me to predict the stock market correct for 4 years, I could open 16 newsletters. The first year have 8 predict up and 8 predict down, and then drop the incorrect ones. Keep doing that until the last year when I have one that predicted every single move correctly. And there's 0 skill involved with that. So when we look at how many investors are out there making predictions, it's not that crazy that we'd have one person who is very successful for a long period of time. And also high performance is not proof of market inefficiency. It could be just luck, and it could be people, I guess, lucking out on higher risk decisions. I guess like one person that illustrates this is Warren Buffett. He looks very successful when we look at his past performance. But again, we can't really tell if it's luck or skill. We look for anomalies in the stock market to capitalize on to get higher returns to perform better than the benchmark. But when we're looking at these, we have to ask ourselves, are they actually real? Again, there's luck versus skill. And we also have the small firm effect, where people say that small stocks outperform large stocks, but it could just be that the small stocks are more risky. So like the Fama French model says that we're just earning a risk premium. We're just being paid more for taking on that risk so other people don't have to. There's also data mining that some people use to develop trends. Like we look at all of our historical data to come up with a trend that describes it. And if we use all our data, then our trend will obviously describe all of that data. So one way to avoid that would be to use half of our data and test it in the rest. And we also want to make sure the anomalies are persistent and repeatable, because if it just happens once, then it happened that one time and we can't ever take advantage of it in the future. And we want the anomalies to be plausible. There was one article once that said that the Super Bowl can predict which way the stock market will move. They had looked at whether the NFC team or the AFC team won, and like over a bunch of years, and they found out that the NFC winning meant the stock market would move up, and if the AFC team won, then the stock market would move down over the next year. And obviously that has no relation to the financial market. And once they published that, then it didn't do so well. busy not trying to
The
predict
the model failed to perform.
All right.
That's hilarious.
Yeah, and so the last one is it exploitable? Sometimes these strategies involve you making huge numbers of transactions, thousands of trades to implement, and it's just not for us. Most investors, it's just you can't exploit it. So
yeah,
here's again APMP students on national television opening the NASDAQ Stock Exchange again. So APMP, it's a year-long course. Okay, select students get to manage a portfolio of real money. They have full control. They get to do everything in their control. There is an APMP advisory board that serves as the client that, you know, the students have to convince them, the board, to hire them. They've won the national investing competition 8 times. They just won it last year, and they'll be leaving for New York here this month. So how can APMP students do so well? How can they win these things? What am I teaching them? Obviously, I must know some great secret. Well, here is the secret. They understand the things that we just talked about, even though I apologize for going through it so quickly. They understand the arguments about systematic risk. They understand that these models that you could earn higher returns by just taking more risk, that's not really doing anything. They understand there's these different anomalies. They understand the dangers of investing in things that you don't understand. What they basically do, though, is they go ahead and through a systematic approach, develop a disciplined investment framework. They go ahead and build this disciplined approach so that they basically already know what they're going to do, kind of regardless of what happens. When COVID happened, they didn't panic. They didn't react. They basically asked themselves a set of questions to come up with a strategy and then execute that strategy to meet the goals of the client. So I tried to make this as fast as possible and boil it down. Obviously, this is a whole course. They basically start by asking the question, is the market efficient? But then they ask a little bit smarter question. Maybe it's not yes or no, maybe it's somewhat, a little bit efficient, a little bit inefficient, a degree. Then they say, wait a second, it's not the market as a whole. Let's ask this question about large cap US stocks. Let's ask this question about small cap stocks. Maybe large cap stocks are efficient. You can't beat the market. You should just hold it. But maybe small caps are inefficient. So if they think the markets are efficient, then they basically decide if they want to be in that market, they just employ essentially passive strategies and minimize the costs. Okay. If they think the markets are not efficient, some particular market segment, small cap stocks, value companies, then they ask those same exact questions. Is it real, the inefficiency? Is it plausible? Is it going to be repeatable? And is it exploitable? Can we actually implement a strategy to take advantage of this? And assuming those answers are yes, then the students ask themselves, do they have the ability to exploit it? So for instance, the students are taking classes, they can't do day trading. So even if the markets were inefficient and you could make money doing day trading, my students aren't going to do that. They're going to pick strategies that they actually have the ability to do. Once they've done that, they go ahead then and execute that strategy. In a nutshell, it's that. I try to boil it down to that fine of a grain of detail. If you don't, what I'm recommending all of you to do is have a fundamental beliefs about how the markets operate, whether they're efficient or not, and then whether or not the inefficiencies are real, plausible, repeatable, exploitable, and whether or not you have the ability to do it, to exploit it. When they do this, they go ahead and answer the following questions. Asset allocation is your highest level. What percentage of your money are you going to put in equities and fixed income? The highest level, your biggest asset buckets. Then they go down through the hierarchy of investment decisions. Are we going to do market timing? Yes or no? Are we going to try to jump in and out of the markets? How are we going to diversify our portfolio? Are we going to diversify by the number of assets? Are we going to diversify by sectors? Are we going to diversify by size? Are we going to diversify by style, value versus growth? And then finally, in the end, how are we going to pick the individual stocks and bonds? And many times people focus on how you're going to buy, how we're going to buy. But I want you to realize as soon as you buy something, you're also committed to selling. So you have to, asset selection is not only thinking about how you're going to buy, but also determining ahead of time why and how you're going to sell the assets. So they go through this hierarchy of investment decisions and have the answers to all of these questions. They know they're going to hold 70% in equities, 30% in fixed income with a 5% range. They know they're going to hold all the sectors with at least a 5% weight and no more than 15% weight. They know they're only going to buy individual stocks if the present value of the cash flows exceeds the current stock price. They know they're going to sell if they already have all those answers before they even start the process. And then they go ahead and execute. They avoid panicking. They avoid simple mistakes. They try to avoid their own behavioral overconfidence, their own irrationality. They understand the risk profile of each of their assets. And this is a Dean Johnson made up word, risk. They eliminate risk. They eliminate not understanding the risk of any of their assets. They go ahead and monitor their performance and continuously keep track of the benchmark, how they're doing relative to the goals in the benchmark. I did it as fast as possible, Janet. At 7 o'clock, we didn't even get the questions yet.
That's okay. All right. So I'm just going to formally thank everybody, and then we're going to go ahead and take questions. And I guess, Sue, let's keep recording because we want to definitely get some questions, and we'll go to 7:15. So if anybody has a question, type them in the Q&A. And I am actually blown away by how much I do not know. Usually I'm like, I sort of get this in these Husky Bites, but I do not know a lot of things. Let's just put it that way.
So I would tell you all this, that the biggest danger is to not invest. That's the biggest danger. Don't be afraid of this. Go ahead and do it. And you're probably going to be much better off than if you don't invest. So you're doing right, Janet.
All right, so folks, you guys handle the questions. So if you're going to answer it live, click on answer live, and then after it's finished being answered, you just move it to answered. Go ahead.
All right. I see Ron Francis here from New York. I know Ron. Thank you very much. So let me find a question. Let me start at the end. So I guess I should just go 60-40 and buy the stock and bond market. That's Tom's question. So Tom, I would simply say to you, okay, remember we talk about the client's objectives. So if we go back in our slides here, Tom, to this graph, right? Tom, here's our graph with 60-40 stocks and bonds. If earning a 9.1% return, compound that from the current age you are to when you want to retire, and 9.1% will get you to your retirement goals. That's it. That's exactly what you should do. If you're comfortable with that much risk, then go for it. If you're very, 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 very risk averse and you can't handle that much risk, well, then you have to make adjustments. You're going to have to save more, retire later, okay? Or you're going to have to get out of your comfort zone. But yep. Okay.
All right,
Harry,
and let's let the students pick some questions. So
sure.
let's kind of take turns, beginning with whoever starts. So go ahead.
Yeah, I can start. So I guess I saw Harry Jones said, doesn't anyone review the individual financials and ratios anymore? And I picked that one because with what Dean is saying, we do look at the broad market in general, but in our APMP teams, we do narrow it down, and when we look to buy assets, we do a full buy report. And so we look into the financials and we get the full picture of the company, what the company has done, what the company wants to do. And so we're really getting the full picture of the individual financials when we make these purchases.
Super. All right, next student. Just jump in.
Jaharee, you guys see the questions in the Q&A? If you have one that you'd like, Kasey.
Yeah, I saw Harry's too. I wanted to answer that one. So sorry.
Now I'll take one while you're picking one. Joe asks, how can we, the audience, invest with the APMP team?
So APMP manages their money through the Michigan Tech Fund. People donate their money to the Michigan Tech Fund, and then the students manage that money. We're not available for direct investing. When we went to set it up, we did think about setting it up as a for-profit thing where the fund would charge a management fee, and the management fee would be the gift to the university, to the tech fund, to the support the program. So
Got it. All
yes.
right. Have you guys picked a question now?
Janet, I had a question from Greg Roth. I think I clicked answer live. It said cryptocurrency, investing or gambling. And Greg, I remember way back at the beginning, I said I didn't want to talk about trading strategies. Traders will trade on anything that moves in value. As long as it has high volatility, people can try to make money by buying low and selling high, and they don't even care about what the thing is. It's just a vehicle for trading. People do that with stocks. People do that with cryptocurrency. I want assets that generate cash flow. So I want assets that can generate profits. A cryptocurrency doesn't create anything. It's just pure speculation. Trading it. I'm not saying you can't make money, but realize you're trading. You're not investing in my world. Investments is investing in things that generate cash flows.
Okay. All right. That's a good distinction. All right, Kasey or Jaharee.
Yes,
You see a
I
question?
saw a question from John Hill and the question was, for the students, how much did the APMP program attract you to the school? So I actually didn't know about APMP until the middle of my third year. So last spring, my academic advisor brought it up, and it didn't what attracted me to the school was the opportunity to play sports as well as a scholarship from the School of Business. So I guess that could kind of attract me. But when I first learned about APMP, it kind of sounded like it wasn't necessarily real. Like they had millions of dollars just to allow students to invest in. So when I first heard about it, it seemed like such an attractive opportunity. And now that I went through it, all the stuff that I've learned, I never would have got in any other course at Michigan Tech.
Cool.
I would like to hop on this one as well because I'm actually a second generation APMP student. So my dad attended Michigan Tech and was an APMP, and I followed in his footsteps and also was an APMP. So I've heard about it my whole life and really excited that I had the opportunity to also be on it.
And so, Kasey, how much money do you have under investment?
It was close to $2 million when we started this year.
Yep.
Wow.
Janet, I saw a question from Gordy Holt. It was, are all financial analysts trained in this, or should I only look for MTU APMP graduates who are now financial advisors? And of course, I would love to tell you, yes, you should only do that, because, and I will tell you that, Jada's kind of dating me, that I would say probably almost all the financial advisors in Houghton probably are graduates of the program at this point. I would say this, that the difference is that sometimes people can sell financial products, and they're selling financial products. So for instance, that Curtis Ray, these are complex products sometimes, and people can confuse people. You want to be working with somebody that actually understands this stuff, yes, and not all of them do. You should definitely be working with somebody that not only just has a college degree, but actually has got some experience like this. Our students present to the client. They understand that they have to build a relationship with the client, understand the client's goals. They have to actually have gone through making these real decisions. So I would strongly recommend that you work with somebody. I don't know if I'll say an APMP graduate, but I would definitely recommend that you have somebody that's had some of these real world experiences while they're still a student. You don't want them training on your portfolio. Let's put it that way.
There's a a question from Kevin Mills that said, what about being an early adopter of new technologies such as AI, EV, or drinking water? And how does the risk model effectively rate the unknown? I guess short answer is it depends. Kind of have to know which model you're using. There's a whole bunch of them. Like there's like the CAPM and the 3-factor models, the 5-factor models that all have different sources of risk. Kind of depends how much research you do and how well you understand it, which will be hard since it's unknown.
Right, and I would also tell you, and in fact, I think I have a slide in here. So I'll hold this up in front of it and hopefully it'll focus on this. This is machine learning for algorithmic trading. You can see how thick it is. It's obviously using tools. And the question, Jada had that question, can we use these modern tools, machine learning, artificial intelligence to manage portfolios? The one warning I would have for you is that in the end, as we saw tonight, humans are the decision makers and we are subject to irrationality, and there's no math model that's going to work perfectly all the time. And if those of you that have ever read the book or heard about the book When Genius Failed, it's about a bunch of very smart PhD professors who basically almost sank the entire financial system because their math model was wrong. It broke down, I should say.
Interesting. All right, we have time for probably 3 more questions, or even one each.
Yeah,
So, go ahead.
I saw a question from Tom Perdona. The question was, if your tech team manages Tech's money, I guess the management team changes every 4 years. So the process is in the spring, the College of Business takes applications for a new APMP team. So at the end of each year, the team ends and a new team comes in and manages the money. And how it works is that depending on how many people they split up the teams. So last year there was 1 team, and then this year there's 3 teams because there was much more people that applied and they split up the money. So it kind of just depends how many people apply after each year.
How many people on a team?
So right now there's 7 on our team, Portage Capital Management. That's our name of our team, but it's usually from like 4 to about 7 people, I would say.
Got it.
Yep.
Cool.
And so Janet, that was a great question. Jaharee gave a great answer too. When I told you the secret of APMP, I didn't tell you, oh, manage stocks using this approach right here, value investing. I didn't tell you that because that can't be true. If value investing was the way then everybody would do it. There can't be one way that beats the market because everybody would copy it. It can't be true. But instead, the secret is to come up with a disciplined approach, avoid mistakes, know what you're going to do, make your decisions about efficient, inefficient, where, how to exploit it, yes or no. So the strategies the APMP team uses year after year changes all the time, 100% up to the students. They have full control. They're basically setting up a new asset management firm every single year.
And I was
That's
going to
really
kind of
cool.
add to that with, I see the question from Dennis saying, is the fund focused on performance only, or does it incorporate the latest ESG criteria as well? And I would say that we're not, being that we're doing the whole process of formulating an investment philosophy, building a team, working with a client, understanding our client and presenting to them, and then implementing our investment philosophy throughout the entire year. We aren't just focused on performance. If we can get performance as well while we go through this process, awesome. But the biggest thing is we're learning how to manage an active fund and work with a team and work with a client and work with our philosophy, especially when we spend so much time implementing these investment philosophies that if we implement them and our performance starts to waver, you can't just go back to square one. You have to stick with that philosophy and see it through. So that's been a really great experience with this program.
And incorporating the ESG criteria too could be something that is part of your philosophy or strategy. So it could depend team to team, year to year.
So are you all going to New York?
Nope, I'm
No.
not.
You're not?
Nope, there's the other, about 10 or 12 of them are going to New York, but these ones are not. They have other things they're doing.
Well, too
So the
busy with
conference-
work.
Yeah, the conference used to be in Dayton, Ohio. Harry Jones asked this question, and the conference used to be in Dayton, Ohio, and we used to go there and we won there. Harry knew that we won there. His daughter attended University of Dayton, but then the conference got moved to New York City. And so we've been going to the New York City conference, and they don't have it in Dayton anymore. So.
And so what kinds of subjects should you take in high school to kind of prepare for earning a degree in the College of Business?
So Jada, if you want for the College of Business, that's a kind of, but I'll stick more to APMP finance investments. As you started to hear, you can be a very quant-oriented person and take lots of math and statistics and even get an undergraduate degree in math and statistics and then come and do this later. But there are jobs that are in that space where you're really into the quant space, and now they're starting to, the AI and the machine learning space. And we're thinking about opening a fund where students would get to manage money using AI, machine learning technology. But there is a whole bunch of other areas of finance where you need to be a people person. You need to be the financial advisor to be able to explain this to people and build trust. Because tonight I went a little high level because it's Michigan Tech. And, but you would blow away the client. This would not be the presentation I would have made tonight on mean variance optimization because it would blow away a client. But yet behind the scenes, that's what's really going on. Yeah.
Fascinating. All right. Anybody else? One more question, or I hate
I apologize,
so long
folks,
in
for
time.
going so long. I apologize for.
Well, you've still got 80 some odd people here. So,
Right.
Well, why don't we do closing remarks? And so my closing remark is thanking the audience and thanking you for your time this evening. And so if you would just have a quick thank you or go Huskies, why don't we start with Jada?
Yeah, I guess thank you for taking the time to listen to us talk about this. And I would say that if you know any students going through the business program and they're not involved with APMP, definitely tell them about it. It's a great experience that gets you ready for the real life workforce. And yeah, thank you.
You're welcome. Jaharee.
Yeah, thank you very much for having me. I appreciate you guys listening to APMP and the stuff that we're doing this year. I would say that any young people that are interested in business or investing, dive right into it. And APMP and the College of Business is a good opportunity to go with. Very
good. Kasey.
Yeah, thanks for having us. It was a good refresher for me, I guess, because I don't necessarily use all this in my day-to-day life right now, but hopefully everybody learned something that they can use.
Very good. And Dean, close us out.
Sure. No, thank you very much. And I put up my last takeaways there. The car mechanic, maybe this was too much for you tonight. That's okay. Know your limit, then work with a financial advisor. Go ahead and try some things on your own. But nevertheless, the most dangerous thing to do is to not be invested at all. And everybody can do this. We have business students on APMP. We have mechanical engineers, forestry, biomed, and form teams. There's all things that everybody can contribute when there's in this team environment. So thank you very much. And again, thank you for listening.
You. No, thank you for really teaching us something. I really appreciate it. Thank you. All right. Good night, everybody.